Hi everyone, welcome back. We are solving questions in Ind AS 36 and let's now look at illustration number 12 of the Institute material. From the following details of an asset, compute the impairment loss and its treatment and the current year depreciation for the year end. So there are going to be certain details that are going to be provided based on which we are supposed to calculate the impairment loss and the depreciation for the said year. The cost of asset is rupees 56 lakhs. The useful life is 10 years. At the time of purchase, the total useful life of the asset was 10 years. Salvage value was nil. All right. So whenever we purchase the asset, we estimated that the salvage value of the asset at the end of its useful life is going to be equal to 0. All right. Based on this information, we can actually calculate what the depreciation per annum would have actually been. The depreciation per annum would be 56 less 0, the whole divided by 10. All right, it would be 5.6 lakhs. So the depreciation would have been 5.6 lakh rupees. All right, the depreciation per annum is 5.6 lakhs. The carrying value at the beginning of the year is 27.3 lakhs. All right, so the question does not require us to calculate the carrying value. They've already given us the carrying value to be 27.3 lakh rupees. So we purchased the asset a few years ago. We do not know when we actually purchased the asset. We used the asset for a next number of years, and after using the asset, the carrying amount is actually equal to 27.3 lakh rupees. All right, we have depreciated it at 5.6 lakhs per annum, and the carrying amount happens to be 27.3 lakh rupees. The remaining useful life, the institute has given, the remaining useful life is 3 years. All right, so the asset was purchased 7 years ago. Remaining useful life is 3 years. All right, 10 years was the total life. We purchased it 7 years ago, and the remaining life is 3 years. Recoverable amount at the beginning of the year is 12 lakh rupees. How would they have calculated this recoverable amount? They would have calculated the value in use and they would have calculated the fair value less cost to disposal. The higher of the two is going to be recoverable amount of rupees 12 lakhs. There's an additional information that's given, which is upward revaluation done in the last year, which is in the last year at the year end is 14 lakh rupees. There was an upward revaluation that was carried out at the end of last year, which was equal to 14 lakh rupees. Now, an upward revaluation basically refers to a revaluation gain being recognized. All right, in the last year, a revaluation gain was recognized is what they're trying to actually mention. There was a revaluation gain in the previous year that was recognized to the tune of 14 lakh rupees. Now, very quickly, to recap, under Ind AS 16, if you are recognizing a revaluation gain, such revaluation gain will not be credited to P&L but will actually be credited to other comprehensive income, and it will be carried as part of accumulated OCI. If you have a revaluation gain in any particular year, generally such a gain will not be credited to the statement of profit and loss, but it will be credited to the statement of other comprehensive income. It will be a part of OCI and it will be carried as part of accumulated OCI. All right, it will be carried as part of accumulated OCI. So this 14 lakh rupees would have actually been credited to accumulated OCI. It would have been credited to the accumulated other comprehensive income. Now, what Ind AS 36 states is, if you have an impairment loss on a revalued asset, in the past, you actually revalued an asset and you recognize the gain and other comprehensive income. And if in the current year, you're actually impairing such an asset, then the impairment loss should not be first recognized to the statement of profit and loss. The general rule that we learned is that any impairment loss will be debited to P&L. But what Ind AS 36 actually states is, if in the past you had a revaluation gain as a result of which you credited your accumulated OCI, and if in the current year on the same asset you're actually required to recognize an impairment loss, then adjust the impairment loss first against the OCI balance. Adjust the impairment loss first against the accumulated other comprehensive income, and any excess impairment loss only will be debited to the P&L. All right. General rule is impairment loss will be recognized in P&L. But an exception is if this impairment loss is on a revalued asset, and if in the past you actually had a revaluation gain, then adjust the impairment loss first against the accumulated OCI. But if the impairment loss is greater than the balance in accumulated OCI, then that excess will be recognized in the statement of profit and loss. The excess only will be recognized in the statement of profit and loss. All right, let's first start by calculating Let's start by calculating the impairment loss itself. All right. So step number one would be calculation of impairment loss. Impairment loss is going to be carrying amount less recoverable amount. Carrying amount was provided as 27.3 lakhs less recoverable amount was 12 lakh rupees. So the impairment loss is equal to 15.3 lakh rupees. All right, impairment loss is equal to 15.3 lakh rupees. Now the question stated that the upward revaluation that was done in the last year was equal to 14 lakh rupees. Therefore, it means that the accumulated other comprehensive income actually has a balance of rupees 14 lakhs with regards to revaluation gain. So of this 15.3 lakhs, rupees 14 lakhs will actually be adjusted against accumulated other comprehensive income, adjusted against revaluation surplus. Revaluation surplus is nothing but a part of accumulated OCI. All right, a part of accumulated OCI. And the remaining rupees 1.3 lakhs will be debited to the statement of profit and loss. It will be debited to P&L account. All right. So the total is 15.3 lakhs impairment loss. Of that 15.3 lakhs, 14 lakhs will be debited to revaluation surplus or accumulated OCI balance on your balance sheet. All right. Accumulated OCI is part of your reserves and surplus, and revaluation surplus is basically a portion of accumulated OCI. Accumulated OCI can actually have multiple components. Revaluation surplus will be a portion of such accumulated OCI. So you will debit 14 lakhs to revaluation surplus, and the remaining 1.3 lakhs will be debited to the statement of profit and loss. If you actually carefully read the question, it actually said compute impairment loss and its treatment. The word treatment was basically trying to emphasize where you will recognize such a impairment loss. Are you going to recognize the impairment loss in the P&L account, or are you going to recognize the impairment loss as a debit to the accumulated OCI, as a debit to the revaluation surplus? All right. Let's also next compute the depreciation for the year end. All right. Okay. So step number two will be calculation of revised carrying amount. All right, after you charge impairment loss, what is the revised carrying amount going to be? All right, the revised carrying amount will be the original carrying amount less the impairment loss that you recognized. Revised carrying amount is going to be the original carrying amount before charging impairment loss less the impairment loss that we recognized. All right, the original carrying amount was rupees 27.3 lakhs less impairment loss was 15.3 lakhs. So the revised carrying amount is going to be 12 lakh rupees. So you had an asset whose carrying amount was 27.3, you charged an impairment loss of 15.3 lakhs, and the revised carrying amount is going to be equal to rupees 12 lakhs. All right, and this obviously also is equal to the recoverable amount as well. All right, remember, impairment loss was calculated in such a way that the carrying amount falls down or is shown at recoverable amount. The impairment loss was calculated in such a way that the asset is reflected at recoverable amount in the balance sheet. So now the revised carrying amount of 12 lakhs should obviously be equal to the recoverable amount itself. All right, so revised carrying amount is rupees 12 lakhs. Now, originally, using the historical cost, we calculated a depreciation of 5.6 lakhs per annum. We calculated a depreciation of 5.6 lakhs per annum. Now, the assets value is only rupees 12 lakhs because we charged an impairment loss. Assets carrying amount is only equal to 12 lakh rupees. And we have a remaining life of 3 years. All right, can I continue to charge the original depreciation of 5.6 lakhs per annum? The answer is no. I cannot use the original historical depreciation of 5.6 lakhs per annum. What I need to do is I need to calculate the revised depreciation that I would have to charge in future, which will be based on this rupees 12 lakhs of carrying amount and the remaining useful life of 3 years. I am going to calculate the revised depreciation to be charged in future, which will be based on the revised carrying amount and the remaining life of 3 years. So the revised carrying amount is 12 lakh rupees, remaining life is 3 years, and salvage value is given as 0. So it's 12 lakhs less 0 divided by 3 years. So the revised depreciation will actually be equal to 4 lakhs per annum. All right, so step number 3 is revised depreciation. Revised depreciation is going to be equal to revised carrying amount less salvage value, the whole divided by the remaining useful life. So revised carrying amount is equal to 12 lakhs. Salvage value is 0. The whole divided by 3 years, which is equal to rupees 4 lakhs per annum. So we are going to charge a depreciation at the rate of 4 lakhs per annum in the next 3 years. Now, the revised carrying amount is 12 lakhs. I will charge a depreciation of 4 lakhs per annum in such a way that the asset's value comes down to 0 at the end of its useful life. The asset's value will come down to 0 at the end of its useful life. It's coming down to 0 because the salvage value in this case is 0. If there was any salvage value, then it would have ended at that salvage value number. All right, if there was a salvage value of 50,000, then the assets carrying amount should at the end of its useful life be equal to 50,000. At the end of a useful life, assets value should always be equal to its salvage value. Because the salvage value is 0 in this case, we're actually bringing down the asset to its 0 value. All right, let's quickly actually look at the institute answer as well. Impairment loss is actually 15.3 lakhs. It's saying that how the treatment of impairment loss, you first charge it against the revaluation surplus. If you notice, what they're saying is, since the asset in the question has been revalued upwards, impairment loss will be first adjusted against revaluation surplus of 14 lakhs. The remaining 1.3 lakhs will be recognized in P&L account. The current year depreciation is going to be equal to 4 lakh rupees. All right, the current year depreciation is 4 lakh rupees. That's with regards to illustration 12. All right, let's do a similar question, question number 14 from the Institute end of chapter questions. All right, this is not the illustration, this is part of the end of chapter questions. On 1st January 2000, year 1, Entity Q purchased a machine which is costing rupees 2,40,000 with an estimated useful life of 20 years and an estimated 0 residual value. Whenever there's a 0 residual value, it's a bumper offer. You can directly do 2,40,000 divided by 20 years to be the depreciation per annum. All right, so the depreciation will be 12,000 per annum in this case. All right, it's going to be 12,000 per annum. Depreciation is computed on a straight line basis. All right. The asset had been revalued on 1st January year 3. 2 years later, 1st January year 1, you purchased it at 2,40,000. 2 years later, you revalued it to 2,50,000, but with no change in useful life as at that date. At that date, the useful life would have been 18 years. The remaining useful life would have been 18 years. And the question is saying we only revalued the value of an asset, but the remaining useful life continued to be 18 years. On 1st January year 4, another year later, an impairment review showed that the machine's recoverable amount was rupees 1 lakh. The machine's recoverable amount was rupees 1 lakh and estimated remaining useful life came down to 10 years. Originally, it was 20 years. You used the machine for 3 years and it came down now to 10 years. All right, you used the machine for 3 years and it now came down, the remaining life came down to 10 years. All right, so the remaining life got slashed down by 7 years. 20 years was the original life, 3 years you used. Now 17 years should have been the remaining useful life, but the remaining useful life is estimated at 10 years. So the remaining useful life has been reduced by 7 years. The remaining useful life was slashed down by 7 years. All right, we are required to calculate A to D. Calculate the carrying amount of the machine on 31st December year 2. They're asking you to calculate the carrying amount at the end of second year and what the revaluation surplus is on 1st of January year 3. Remember, on 1st January year 3, you actually revalued the asset to 2,50,000. So what they're actually asking you to do is calculate the revaluation surplus. The revaluation surplus is nothing but the 2,50,000 less the carrying amount on 1st January year 3. 2,50,000 less the carrying amount on the 1st January year 3 will be equal to the revaluation surplus. Next one is the carrying amount of the machine on 31st December year 3. All right. At the end of third year, what is the carrying amount of the machinery before you charge the impairment? All right. Impairment was charged on 1st January year 4. They're asking you to calculate the carrying amount of the machinery on 31st of December year 3. The impairment loss that is recognized in the year to 31st December year 4. So basically in year 4, when you're actually calculating what is the impairment loss and its treatment thereon. Treatment basically means, is it going to be charged to P&L or is it going to be charged against revaluation surplus? And the final one is the depreciation charge in year 4. What is the impairment loss in year 4 and what is the treatment and what is the depreciation charge in year 4? All right, what's the depreciation in year 4 is the other 4 requirements. All right, let's start with the first bit, which is finding out the carrying amount of the machine on 31st December year 2. All right, so step 1, carrying amount of machine on 31st December year 2. So the historical cost was 2,40,000. We charge depreciation for year 1 and depreciation is calculated as 2,40,000, the whole divided by 20 years. The reason we're able to do 2,40,000 divided by 20 is because salvage value is actually equal to 0. All right. So we charge depreciation for year 1 as 12,000. The carrying amount at end of year 1 is going to be 2,28,000. The carrying amount at the end of year 1 is rupees 2,28,000. I reduce depreciation again for year 2, which will be equal to 12,000 only because we're charging a straight line basis. And that's going to give me the carrying amount at end of year 2. All right, the carrying amount at the end of year 2 will be 2,16,000. All right. So the historical cost was 2,40,000. I charged depreciation at the rate of 12,000. I charged depreciation at the rate of 12,000 for a period of 2 years. For a period of 2 years, I charged depreciation at the rate of 12,000 and the carrying amount at the end of year 2 is 2,16,000. All right. So the carrying amount as of this 31st of December year 2 is 2,16,000. Step number 2 will be calculation of revaluation surplus. I have an asset whose carrying amount in the books is 2,16,000. I've got an asset whose carrying amount in the books is 2,16,000. I want to actually increase the carrying amount to 2,50,000. All right, the question stated that I would like to increase the asset. The asset has been revalued to 2,50,000. All right, so 2,16,000 in my books should now be reflected at 2,50,000, which means I will calculate the revaluation surplus as the difference between the two. All right, revaluation surplus is going to be equal to revalued amount less the carrying amount. All right, revalued amount less the carrying amount. Revalued amount is 2,50,000. Carrying amount is equal to 2,16,000, which means I have got a revaluation surplus of rupees 34,000. I've got a revaluation surplus of rupees 34,000. The journal entry for this would have been fixed asset debit or plant and machinery debit to revaluation surplus, all right, which is a portion of other comprehensive income. All right, fixed asset debit or plant and machinery debit to other comprehensive income or to revaluation surplus. All right, so 2,50,000 less 2,16,000, which is equal to 34,000 rupees. All right, so the journal entry, although the question is not asked, I'm actually plotting down the journal entry. It's basically going to be plant and machinery debit 34,000 and credit would be to other comprehensive income, and within other comprehensive income there'll be a row called revaluation surplus. All right, just like how you have different rows in the P&L, within other comprehensive income also you're going to have different set of rows, and one of the rows will be revaluation surplus, where we will be reflecting 34,000 of gain. All right, so there was an asset whose carrying amount was 2,16,000 at the end of year 2. I have decided that the revalued amount will be 2,50,000, and therefore 34,000 will be equal to the revaluation surplus. All right, 34,000 is going to be equal to the revaluation surplus. That answers part A. All right, the carrying amount is going to be 2,16,000, revaluation surplus is going to be 34,000. All right, let's now move on to part B. Calculate the carrying amount of the machine on 31st of December year 3 immediately before the impairment. Now, the assets carrying amount that we calculated at year 2 was 2,16,000. We decided to revalue the asset at 2,50,000 and therefore recognize the revaluation surplus of 34,000. Now, the asset whose original carrying amount was 2,60,000, 16,000, after recognizing revaluation gain would become 2,50,000. 2,16,000 would become 2,50,000 because you're increasing the value of your machinery. You're increasing the value of the machinery. So the assets carrying amount after revaluation is equal to 2,50,000. Now, you cannot continue to charge the depreciation of 12,000 which you calculated based on 2,40,000 of historical cost. The 12,000 was calculated based on a historical cost of 2,40,000. But your assets carrying amount right now is 2,50,000. Because of revaluation, the assets carrying amount has actually increased to 2,50,000. Therefore, what you have to do is you have to now calculate the revised depreciation. You cannot continue to charge the old depreciation of 12,000. You now have to calculate the revised depreciation based on 2,50,000 carrying amount and based on the remaining useful life of 18 years. How do I get 18 years? 20 years was the total life at the time of purchase. 2 years have passed by, and therefore the remaining useful life is 18 years. All right, so what we are going to do is we are going to calculate the revised depreciation that has to be charged in year 3 based on the revised carrying amount of 2,50,000 after considering revaluation and based on the remaining useful life of 18 years. All right, 20 years less 2 years which we've already used, so the remaining life is 18 years. All right, so step number 3 is going to be calculation of depreciation for year 3. Depreciation for year 3 is going to be 2,50,000, which is equal to the carrying amount of the asset after revaluation surplus less salvage value, which is equal to 0, divided by the total remaining useful life of 18 years. So it will be 2,50,000 divided by 18, which is equal to rupees 13,888 or 89. All right, so 2,50,000 is the revised carrying amount after considering revaluation divided by the remaining useful life of 18 years, and the total depreciation for year 3 will be equal to 13,889. So remember, you have to calculate a revised depreciation, whether there is a revaluation or whether there's an impairment. Both revaluation and impairment result in a change in the carrying amount of the asset, and both of them will actually result in a recalculation of depreciation. You cannot continue to charge depreciation based on the original calculations, even whether there is a revaluation or whether there is an impairment. You have to now calculate a revised depreciation based on the revised carrying amount and the remaining useful life. All right, so whether there's an impairment or whether there's a revaluation, you always recalculate depreciation because your old depreciation depreciation no longer holds good. Your carrying amount of the asset changes, and therefore your old depreciation does not hold good, whether there's an impairment or whether there's a revaluation. In this case, we have actually done revised depreciation because there is a revaluation. 2,16,000 became 2,50,000, so I can no longer use the old depreciation. I've calculated the revised depreciation as the revised carrying amount after revaluation less salvage value, the whole divided by remaining useful life. All right, so the carrying amount of the machine at the end of year 3 will be, so step 4 will be carrying amount on 31st December year 3, that will be equal to carrying amount on 1st January year 3, which is the date of revaluation, less depreciation for year 3. All right, carrying amount on 1st Jan year 3 after revaluation is 2,50,000 less 13,889 of depreciation for year 3 is going to be equal to rupees 2,36,111. All right, it's going to be 2,36,111. So carrying amount of the year of the machine on 31st of December year 3 before you calculate any impairment is 2,36,111. All right, let's move on to part C. What is the impairment loss? Calculate the impairment loss that is going to be recognized in year 4. Because the reason he said year 4 is because impairment review is being done on 1st January year 4. Impairment review is being done on 1st January year 4. So any impairment loss will actually be recognized in year 4. All right, so the carrying amount on 31st December year 3 of 2,36,000 will obviously become the carrying amount also on 1st January year 4. This is also the carrying amount on 1st January year 4. All right, whatever is the carrying amount on 31st December year 3 will become the carrying amount on 1st January year 4. All right, step number 5 is going to be calculation of impairment loss. Impairment loss is going to be calculated as carrying amount less recoverable amount. Carrying amount is equal to 2,36,111 less recoverable amount is equal to 1 lakh rupees, and therefore impairment loss is equal to 1,36,111. All right, you have an impairment loss of rupees 1,36,111. An asset's carrying amount right now is 2,36,111. But when you calculated the value in use and fair value less cost to dispose, that amount actually came up to 1 lakh. The recoverable amount came up to 1 lakh, and therefore impairment loss will be 1,36,000, whereby we are going to reduce the carrying amount. We are going to reduce the carrying amount from 2,36,000 to 1 lakh rupees. All right, by charging an impairment loss of 1,36,111. All right, now let's move on to the treatment of impairment loss. The total impairment loss that we have recognized is 1,36,111. Now, but this impairment loss is being recognized on an asset which was actually revalued in the previous year. As at 1st January year 3, we revalued the asset and recognized a revaluation gain of 34,000. Alright, we had recognized the revaluation gain of 34,000. And the same asset 1 year later on 1st January year 4 is being impaired by 1,36,000. Alright, this 1,36,000 will not be entirely charged to the statement of profit and loss. This 1,36,000 will first be charged or adjusted against the credit balance and the revaluation surplus. So out of this 1,36,000, first we are actually going to adjust the accumulated OCI or revaluation surplus balance. Any excess only will be charged to the P&L account. All right, any excess only will be charged to the P&L account. All right, so step number 6 is going to be the treatment of impairment loss. So total impairment loss is going to be equal to 1,36,111. Revaluation surplus is equal to 34,000. So therefore, The impairment loss that will be charged to the P&L will be 1,02,111. All right, this is the impairment loss that will be charged in the P&L account. If there is an asset which has been revalued in the past, and as a result of such revaluation, a revaluation gain was recognized, then in the current year, a portion of the impairment loss will be adjusted against the revaluation surplus. A portion of the impairment loss will be adjusted to the extent we have revaluation surplus, and any excess only will be taken to the P&L account. Any excess impairment loss only will be taken to the P&L account. All right, so the journal entry for this would basically be impairment loss debit in P&L of 1,02,111. We debit revaluation surplus, which is a part of accumulated OCI, by 34,000, and we credit asset by 1,36,111. The assets value in total is coming down by 1,36,000, but that entire 1,36,000 is not going to be charged to the P&L account. A portion of it is going to be charged to the revaluation surplus, which is 34,000, and the remaining alone will be charged to the P&L account of 1,02,111. This was about the part 3, where we were required to calculate the impairment loss recognized in year 4 and its treatment. The last part is basically the depreciation charge in year 4. The depreciation charge in year 4 is the last part that we are required to calculate. Now, this asset was actually coming in the balance sheet on 1st January year 4 at 2,36,000. This asset was reflected in the balance sheet on 1st January year 4 at 2,36,000, and after charging impairment loss, the asset's value would come down to 1 lakh rupees. We have recognized an impairment loss of 1,36,111. So the asset's value on 1st January year 4 after recognition of impairment loss is going to be equal to 1 lakh. 236 less 136, which is equal to 1 lakh rupees. All right, so step number 6, I'm actually calculating the carrying amount on 1st January year 4 after impairment. It's going to be 2,36,111 less impairment loss of 1,36,111, that is equal to rupees 1 lakh, which is obviously also again equal to recoverable amount itself. All right, so the carrying amount on 1st January year 4 after recognition of impairment, is going to be equal to rupees 1 lakh. Now, this 1 lakh is going to be depreciated over its remaining useful life. You cannot continue charging the depreciation based on the previous values because the carrying amount of the asset has now undergone a change. All right, the depreciation that you calculated based on the previous values are no longer going to be relevant because the carrying amount has actually undergone a change. Because the carrying amount has actually changed, you're going to calculate a revised depreciation based on the remaining useful life. Now, the question actually clarified that the remaining useful life is only 10 years now. All right. Although you've used the asset only for 3 years, originally you estimated a total life of 20 years. Logically, the remaining useful life should have been 17 years, right? But the question clarified, but the asset's remaining useful life is not 17 years. It's actually equal to 10 years. So this carrying amount of rupees 1 lakh should be depreciated over the remaining useful life of 10 years. So the depreciation for year 4 depreciation for year 4 is going to be based on 1 lakh, which is the carrying amount after recognition of impairment loss, less salvage value, the whole divided by 10 years, which is equal to rupees 10,000 per annum. All right. So the depreciation that we would be charging for year 4 is equal to 10,000 per annum. All right. How did we calculate this 10,000 per annum? We took the carrying amount after recognition of impairment loss. That carrying amount is going to be depreciated over its remaining useful life. Remaining useful life has been re-estimated as 10 years, and therefore this 1 lakh is depreciated over 10 years at the rate of 10,000 per annum. All right, let's now quickly actually refer to the institute solution as well. This was question number 14. Calculation of the carrying amount at the machine at the end of year 2 is 2,16,000, 12,000 of depreciation per annum. So for 2 years, depreciation was 24,000. Carrying amount of the machine on year 3 or revaluation surplus is basically 34,000. The impairment loss that was recognized is equal to 1,36,111. The impairment loss is 1,36,000. An impairment loss of 34,000 will be taken to other comprehensive income, reducing the revaluation surplus to zero, and the remaining impairment loss of 1,02,000 is going to be recognized in the statement of profit and loss. And the depreciation charge for year 4 is going to be equal to 10,000 rupees. All right, the depreciation charge is going to be equal to 10,000 rupees. That was with regards to question number 14 at the end of chapter questions. All right, this was not an illustration, but this was an end of the chapter question that we just did.